Welcome to the Deep Dive. We turn complex info into clear, actionable insights. Today, we're digging into your sources on U.S. rental income and IRS compliance. Super crucial stuff if you're a real estate investor. Our mission: cut the jargon, pull out the key bits so you leave feeling, genuinely clued in.
Yeah, it's a fascinating area because really, smart tax management is, well, it's fundamental to making a profit as a landlord. Getting these IRS rules right isn't just paperwork, it's about finding savings and, frankly, avoiding some nasty penalties.
Okay, let's dive in. What exactly does the IRS count as rental income? I mean, it's got to be more than just the monthly rent payment, right?
Oh, definitely. And what's interesting or maybe surprising is just how broad it is. For most landlords, income is counted when you actually get it. That includes advance rent. So say you get first and last month's rent up front.
Yeah.
That whole amount is taxable income in the year you receive it. Doesn't matter what period it covers.
Wow, okay. Taxed immediately. What about security deposits then? Are they income too?
Good question. A true security deposit, one you fully intend to give back, is an income. It's treated more like a liability on your books.
Okay, that makes sense.
But, and this is the important part, if you end up keeping some, or all of it, maybe for damages or unpaid rent,
Right.
that part becomes taxable income right then. And watch out, if you call something a security deposit, but it's really meant to be the last month's rent, the IRS just calls it advance rent.
So taxable right away again.
Exactly. Even if your tenant pays one of your bills directly, like, say, the water bill, that counts as rental income to you.
Really?
Yep. Though, the upside is you can then deduct that same amount as a utility expense. Same idea if you accept services or even property instead of money for rent. The fair market value of whatever you received, that's income.
Lots of ways income can show up. Now, something that jumped out from the sources, especially for homeowners maybe renting out a vacation spot. The 14-day rule.
Yes, that's a really interesting one. It raises a key point for anyone with, say, a second home or vacation property. If you rent that property out for 14 days or fewer total during the entire tax year,
Yeah.
you actually don't have to report any of that rental income to the IRS. None of it.
Seriously, tax-free.
Tax-free income. The flip side, though, is you can't deduct any rental expenses associated with it either. The IRS basically just treats it like your personal home in that situation. It's a pretty valuable loophole for short-term rentals, maybe during big events.
Okay, that's huge. So, moving on, reporting this stuff. Schedule E, Schedule C. It sounds like getting this right is critical. Why the different forms?
So it's a fundamental distinction, and yet it really changes your tax picture. The default for rental real estate is that it's a passive activity. So you report it on Schedule E.
Passive activity, meaning...
Generally, if you have losses from the rental, you can only use them to offset income from other passive activities, not, say, your regular job income.
Gotcha. So what makes it Schedule C then?
Schedule C is for when your rental activity becomes more like an active business. This usually happens if you provide what the IRS calls substantial services. Think hotel-like services. Daily cleaning, maybe providing meals, often for short-term rentals where the average stay is like 7 days or less.
Like an Airbnb that's run more like a B&B.
Exactly. If you hit that threshold, it's an active business reported on Schedule C. The big difference: net profits on Schedule C are subject to self-employment taxes, Social Security, and Medicare.
Ouch.
Yeah, that's the downside. But the upside is, if you have a loss on Schedule C, you can usually deduct it against your other income, like W-2 wages. So
Yeah.
it's a strategic decision.
Right, weighing the SE tax against potential loss deductions. Okay, deductions. This seems like a minefield. What's the biggest mistake landlords make here, according to the sources?
One of the absolute classic errors, and something the IRS looks closely at, is confusing repairs with capital improvements.
Repair versus improvement. What's the core difference?
Okay, think of it like this. A repair just keeps the property in its current working condition. Fixing a leaky faucet, patching a hole in the wall, that kind of stuff.
And you deduct that right away.
Yes, you expense it in the year you pay for it. An improvement, though, is something that adds value, adapts the property to a new use, or significantly extends its life.
Like putting on a new roof.
Exactly. Or replacing all the windows with energy-efficient ones, not just fixing one broken pane. That's an improvement. And improvements can't be expensed immediately. They have to be capitalized and depreciated over many years.
And getting that wrong could be costly in an audit.
Very. They'll reclassify it and adjust your taxes, potentially with penalties.
Okay, depreciation. You mentioned it for improvements, but the sources called it the most powerful deduction. Why is it so important, and what happens if you just forget to take it?
Well, here's the kicker. Depreciation isn't really optional in the IRS's eyes. It's considered mandatory. It's basically an allowance for the wear and tear on your property over its useful life. For residential rentals, that's typically set at 27.5 years.
So you get a deduction each year for 27.5 years.
You're supposed to, yes. It's a non-cash deduction, meaning you don't spend money that year, but you still lower your taxable income. But here's the trap. If you don't claim the depreciation you're entitled to each year,
Yeah.
the IRS still reduces your property's cost basis. That's the figure used to calculate your profit when you sell as if you had taken it.
Wait, so you lose the annual tax break?
And then when you sell, you get hit with tax on the depreciation you should have taken. It's called depreciation recapture, and the tax rate on that can be up to 25%.
Oof. So you pay tax on a benefit you never actually got.
Precisely. It's a really common and expensive mistake. Don't skip depreciation.
That definitely underscores the need for good records. How does the IRS even catch unreported income or these kinds of errors anyway?
They have pretty sophisticated systems now. There's something called the Automated Underreporter Program. It basically cross-references the information on your tax return with data reported by third parties. Think Form 1099-K from payment processors used by platforms like Airbnb or VRBO. They report the gross rental income they process for you. Or Form 1098 from your mortgage lender, showing the mortgage interest you paid. If the IRS sees a 1098 for a property address, but you haven't reported rental income or claimed it as your primary home,
Red flag.
big red flag. Your absolute best defense is solid, meticulous record keeping. Seriously, use separate bank accounts and credit cards for each rental property. Keep every single receipt and invoice. Digital copies are great.
Makes sense. So, worst case scenario, what actually happens if you get caught with unreported income or major errors? What are the consequences?
They can be pretty severe. There's a standard 20% accuracy-related penalty if the underpayment is due to negligence or substantial understatement of income tax.
20% on top of the tax.
On top of the tax, yes. And if they determined it was intentional tax evasion, you could be looking at a civil fraud penalty of up to 75% of the underpayment.
Wow, 75%.
Plus, interest piles up daily on both the unpaid tax and the penalties. It adds up fast. Now, simply saying, I didn't know the rules, usually isn't a valid excuse. Ignorance of the law,
Right.
But the IRS can sometimes abate penalties if you can show reasonable cause for the error. Things like relying on incorrect advice from a tax pro, or maybe records being destroyed in a fire or flood. But you need good proof.
Okay, so bottom line, understanding what counts as income, getting Schedule E versus C right, knowing repairs from improvements, and always taking that mandatory depreciation, it all comes down to diligence and good records.
Absolutely. Which really brings up a question for you, the listener.
Yeah.
How are you actually tracking all this stuff right now? Your income, your expenses, your time. What steps could you maybe take starting today to build a really solid, undeniable audit trail for your rental properties?
And thinking bigger picture, could getting serious about tax planning turn your rental from just a side thing into, well, a real powerhouse asset? If this deep dive sparked more questions, and it probably did, maybe think about talking to a qualified CPA who really specializes in real estate tax, that kind of professional advice, it could honestly be a critical investment.